Hey everyone, welcome to another episode of the Wealth Breakdown Podcast. Today we are going to be looking at a practical case study of a Roth conversion and hopefully give you an idea of where this might be applicable and to help you execute it if you desire. So, Roth IRAs have a number of advantages over traditional IRAs. So lower overall taxable income in the long term, tax-free rather than tax-deferred growth, no required minimum distributions, otherwise referred to as RMDs at age 73, tax-free withdrawals for beneficiaries after the death of the owner, more effective funding of a bypass trust, and facilitates 3.8% net investment income tax, or NIIT, planning and income smoothing. So whether a Roth conversion will be favorable for a particular client or taxpayer, however, depends on the facts of the case. Although a Roth conversion might make sense more often than not, a detailed analysis is required to determine whether it provides an overall benefit in a particular case. So this analysis in this case study begins with a comparison of the taxpayer's marginal income tax rate at the time of the conversion and the taxpayer's expected marginal income tax rate when distributions are received. If the tax rate at the time of the conversion is lower, the taxpayer will achieve a better economic result by converting. If the tax rate is expected to be far higher when the distributions are received, the taxpayer will generally be better off not converting. If the tax rate at the time of conversion is expected to be slightly to moderately higher than at the time of distribution, a Roth IRA conversion might still be advisable because of special factors that favor a Roth IRA. Another great thing to note is that for business owners specifically, if you have carry forward net operating losses, those can be used to offset converting a traditional IRA to a Roth IRA, because when you take a conversion of a traditional IRA, that comes to you as taxable income, which is offset by the net operating losses. So perhaps the most important of the factors that I mentioned is that if a taxpayer can pay the Roth conversion tax with outside funds, meaning you have an IRA and a taxable account, if you can pay the tax with the taxable account, that's better than paying with the converted funds. So I'm going to share my screen here. And for those of you on podcast, I encourage you to either read the show notes or check out this part of the video. So give me 1 second and we'll share that up on screen. So let's go over an example. So we're going to be talking about Wilma. So Wilma is a single taxpayer in a 40% combined federal and state income tax bracket in 2024. She has $1 million in a traditional IRA and 400,000 of liquid assets in a side fund or a taxable account, which may be used to pay the taxes from a Roth IRA conversion if Wilma chooses to do one. Now, let's assume that the assets in the IRA will increase in value by 300% by the time Wilma retires in 30 years. But the side fund will grow by only 200% because it is subject to tax. It is a taxable account. At the end of the 30-year period, Wilma will receive a distribution of the full amount in the IRA and will be in the same 40% marginal income tax bracket. So the charts that you see here and the tables compare the terminal wealth from a traditional IRA and a Roth IRA. So let's look at, no conversion. So leave assets in the traditional IRA. The total terminal wealth in this case of A, no conversion, leave assets in traditional, is 3.6 million. Now let's look at B, Roth conversion, but don't use the taxable funds to pay the conversion tax. So total terminal wealth, 3.6. Now let's look at C, use the side fund to pay the conversion tax. The good thing about that is that you've used the taxable funds and you've packed more into the IRA, which is a tax deferred, and a Roth is tax-free vehicle, so you get a lot of benefit there. So the terminal wealth is 4 million because again, you use that side fund or the taxable account to pay into the Roth to pay the taxes on the conversion rather than the traditional IRA fund. So the 400,000 difference in these instances is due to the fact that that side fund or the taxable account was in effect. So you've effectively added 400,000 to the IRA by using the side fund. So there are many other factors that might favor a Roth conversion. So if a taxpayer has special favorable tax attributes, so if you have charitable deduction carry forwards, investment tax credits, net operating losses, like I mentioned before, high basis, non-deductible traditional IRA that may help offset the taxable conversion amount. So suspension of the required minimum distribution rule provides a big advantage to the Roth IRA holder if the holder doesn't need the payments for support and can accumulate them and transfer to their heirs. This is often referred to as the legacy Roth IRA. So taxpayers benefit from paying income tax before the estate tax compared to income tax deduction obtained when a traditional IRA is subject to the estate tax. Making the Roth IRA election during your lifetime reduces the overall estate and potentially lowers estate taxes too. So if you're married filing jointly, the tax brackets tend to be more beneficial. So considering if you're going to get married, it may be better to wait until that time to make a conversion because the tax rate on the income from the conversion will be lower. Another great thing is post-death distributions to beneficiaries are tax-free, which is especially important with an estate tax currently in play as high as it is. So Roth conversions tend to take advantage of different factors, and they fall into 4 different categories. There's strategic conversions, which take advantage of a client's long-term wealth transfer objectives. There's tactical conversions, which are short-term, client-specific income tax attributes. Either you're in a low tax bracket for a certain year, you have carryovers and losses. You can do opportunistic conversions, so taking advantage of short-term stock market volatility to potentially convert. You can do a hedging conversion based on future events that you think or that will take place that will subject you to a higher tax rate in the future. You can go ahead and take income at the current lower rate before you're subject to those higher taxes. So one thing with higher net worth folks is avoiding the 3.8% net investment income tax. The addition of the 3.8% NIIT created an additional reason for doing a Roth IRA conversion, income smoothing. So recall that the amount of NIIT is the lesser of net investment income or the excess of modified adjusted gross income over the applicable threshold amount. That's getting a little technical, but your CPA and me can certainly work that part out. Distributions from a traditional IRA are not considered net investment income, but they do increase your modified adjusted gross income. Thus, they could create or increase a taxpayer's net investment income tax. On the other hand, a Roth IRA distribution is neither net investment income nor modified adjusted gross income, so it does not create or increase a taxpayer's NIIT. So a taxpayer can use a Roth IRA conversion to keep future income out of higher brackets and eliminate all future NIIT on IRA distributions. So an example of what someone who might want to do this is if you're going to sell a business for a lot of money in the future, and most of your income is going to be derived by distributions and dividends from an investment account, this could be favorable for you. And we got this handy little chart down here just to show you what the impacts are. Let's see. Okay, so we've got example 2 here where we've got a taxpayer who's filing single, has salary income of $100,000 and dividend income of $100,000. So the taxpayer is not subject to the NIIT despite having $100,000 of net investment income because his modified adjusted gross income does not exceed his ATA. If a taxpayer's income is currently lower than it is expected to be in the later years, the taxpayer might want to do a Roth conversion to smooth out income. The conversion can be done in stages so that the tax payable on the conversion doesn't push the taxpayer into a higher tax bracket, and taxpayers can limit the conversion to the amount that fills up their current marginal tax bracket. This is typically referred to as filling up the tax bracket, which you can see a nice little graphic here in my shared screen over to the right. So if you're interested in Roth IRA conversions, we've got tools that can help you. Many CPAs do as well. Feel free to reach out to us, and we look forward to seeing you on the next episode. Thank you. If you found this valuable or applicable, please click the Contact Us button below to answer a few simple questions and get scheduled with a Bloomwood advisor to discuss your unique situation. The information covered and posted represent the views and opinions of the guests and does not necessarily represent the views of Bloomwood. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for financial, legal, or tax advice. Always seek the advice of your financial advisor or other qualified professional with any questions you may have. Bloomwood is a Georgia and North Carolina registered investment advisor with its principal place of business in Atlanta, Georgia. Bloomwood and its representatives are in compliance with FINRA and state regulation in the states where Bloomwood maintains clients. Bloomwood may only transact business in those states in which it is registered to do so or is exempt from registration. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same result. This content does not constitute tax advice, legal advice, or financial advice, and does not create an advisor-client relationship between Bloomwood and the listener. This case study is designed to give you an overview of the impact that proper tax and financial planning can have on your financial life. The figures in this case study are not calculated to the exact penny and are designed to facilitate a conversation. Thank you.